The dollar, the euro, these currencies every day, it seems like they're taking turns and who's the least worse, if you will. The euro gets beat up every time there are more worries about Greece. The dollar always hit hard on weak economic data. Joining me to discuss the crazy world of currencies, Axel Merk of Merk Funds, a money management firm that focuses exclusively on currencies. Axel, let's talk about the euro and the dollar. I mean, these are two somewhat hated currencies. I've talked to a lot of people, including you, who've mentioned that in some respects people are just short the dollar and the euro and long everything else. Is that a smart move right now? I mean, what do you think of these two leading developed world currencies?
Yeah, well, good to be with you. I think it's fair to say that the euro is one of the most hated currencies right now, and as such we actually think there's a lot of value, and that's because it is far more difficult to spend and print money in the eurozone. One of the reasons why they're going through so much pain in the eurozone is because they're not just throwing money at Greece, they actually have them engage in reform. One of the big challenges in the US is that we printed so much money, spent so much money, and as a result we've lost the will to engage in reform. And that's why in the US we don't have real reform, but in Europe we have true reform. You also have a hated currency, and there might be just some value there.
Moving on, though, from some of the concerns about fiscal policy in Europe and the U.S., let's talk about monetary policy. The ECB raising interest rates, people wondering just how many more rate hikes are in the cards. But we know the Fed's not going to be raising rates anytime soon. At the same time, you have other central banks. China just raised rates again. A lot of the emerging markets that have exposure to commodities have been raising interest rates. What's that going to mean for the dollar?
What we see is culturally a very, very different thing to Europe. In Europe, with some exceptions, the European consumer stopped spending a decade ago. And as such, higher interest rates are not derailing European consumer spending. And on the other end of the spectrum, you mentioned commodities. The Federal Reserve historically is ignoring commodity inflation. The European Central Bank, together with most other central banks, take commodity inflation very seriously. That's why you have many central banks around the world in tightening mode, and that will continue to be the place. Just imagine, should the U.S. recovery pick up pace and there's be even more commodity inflation, while the rest of the world is going to be far tighter than the Federal Reserve in the U.S. As a result, the U.S. monetary policy is going to be more accommodating, and the U.S. dollar is likely to be significantly weaker for years to come than other currencies such as the euro.
So to bring it all back home, there are a lot of people that occasionally talk about the dollar losing its status as the world's reserve currency. It seems a little simplistic and premature to maybe say that right now, because when you look at big central banks like China, they're not really going to be loading up on the euro or the British pound or the Swiss franc at the expense of the dollar probably at this point. But can you envision a scenario several years from now where if the dollar continues to weaken, we do have to find an alternative currency, be it what the IMF has proposed or, dare I say it, gold, as ludicrous as that may sound?
There is no such thing anymore as a safe asset. You cannot rely on your government, be it the Germans, the Chinese, or the U.S., to preserve your purchasing power. So you have to take a more proactive approach, and a managed basket of currencies is what central banks do, and investors may want to do something similar or look at that anyway.
No, it's a great point to wrap up on. Diversification, regardless of what asset class you're talking about, is always key. Axel, thank you so much for joining us.
My pleasure, anytime.